We'll look at historical data, expose the flaws in our own psychology, and I'll give you a specific, executable strategy that works whether the stock goes up, down, or sideways next week. By the end, you'll have a clear answer tailored to your own investor profile, and you'll be able to take action without regret. First, let's address the core of the anxiety, the fear of buying at the peak. It's a rational fear. NVIDIA is a volatile growth stock, and it has experienced significant corrections. History is our best teacher here. Let's look back. These dips, in hindsight, were buying opportunities for long-term investors, but in the moment, they felt terrifying. The key takeaway is this: volatility is not an exception for NVIDIA, it is a feature. The stock's incredible upward trend is not a smooth line, it's a volatile, jagged staircase that moves higher. If a 20% drop would cause you to panic sell, then you should not be buying this stock in any size, at any price. Your psychology is your biggest risk. Now, let's analyze the wait for a dip strategy. On the surface, it sounds smart. Buy low, right? The problem is operational. What is a dip? Is a 5% pull back enough? Or are you waiting for a 10%? 15% or 20% crash? You need a specific number, and then, if the stock starts falling, human psychology works against you. At a 5% dip, you'll think, this is just the start, I'll wait for 10%. At 10%, fear takes over. The trend is broken, it's going to 20%, I'll wait. And if it then reverses and starts climbing, you're left on the sidelines, waiting for a pullback that never returns to your arbitrary buy level. This is the curse of trying to time the market perfectly. You're competing against algorithms, institutional traders, and millions of other investors all trying to do the same thing. More often than not, the wait for a dip approach leads to perpetual waiting and, ultimately, buying at a higher price out of sheer FOMO when the stock breaks to a new high. I've done it. You've probably done it. It's a losing game for most. So, if trying to guess the perfect entry point is a fool's errand, what's the solution? We need a strategy that respects both the potential for future growth and the certainty of future volatility. That strategy is a one-to-punch strategic allocation and dollar-cost averaging. Let's break it down. Step 1 is strategic allocation. This answers the question, how much of my portfolio should this one volatile stock be? This is your most important decision, more important than the entry price. Let's say you have $10,000 you're ready to invest. A strategic move is to decide that NVIDIA will represent, for example, 5% of your target portfolio. You do not invest your full $500 or $1,000 allocation in one lump sum today. Instead, you break it into smaller, regular purchases over time. If the stock goes down, your later purchases buy shares at a cheaper price, lowering your average cost per share, and you're also happy. You win either way because you're systematically building a position. This method eliminates the emotional burden of picking the perfect moment. It turns you from a speculator trying to guess the market's next move into an investor executing a disciplined plan. For a stock as volatile as NVIDIA, DCA is not just a good idea. For a beginner or anyone prone to second-guessing, it is often the best idea. But what if you still want to try to catch a better entry? There's a smart, hybrid approach. You combine a small initial DCA starter position with a set of strategic limit orders to catch a dip automatically. Here's exactly how to do it. Let's use the $1,000 allocation example. First, you immediately invest $200 as your starter position using a market order. You're in the game. No more paralysis. Then, you take the remaining $800 and set up for separate limit buy orders, each for $200 at progressively lower prices. You need to decide what a meaningful dip looks like based on the stock's recent behavior. Look at the chart and identify areas of support levels where the stock has bounced before. Maybe the stock is at $950. Other catalysts include major AI announcements from competitors, macroeconomic data on interest rates, and broad tech sector sell-offs. Use these not as signals to buy or sell, but as reminders of why your DCA plan is so valuable it ensures you're rebuying through both calm and stormy markets. Finally, the most important question to ask yourself isn't about the stock's price. It's about your timeline. Why are you buying NVIDIA? The friction of trying to save 5% on your entry can cause you to miss 100% of the long-term gain. Your focus should shift from pinpoint entry to durable conviction. Build your position slowly, hold through the inevitable volatility, and let the long-term trend be your friend. Critical disclaimer: I am not a licensed financial advisor. This is not financial advice. All investments carry risk, and past performance of any security, including NVIDIA, does not guarantee future results. The strategies discussed like dollar-cost averaging do not ensure a profit or protect against a loss in declining markets. You must evaluate your own financial situation, risk tolerance, and investment objectives. Consider consulting with a qualified financial professional before making any investment decisions. In conclusion, should I buy NVIDIA or wait for a dip? Is the wrong question. The right question is, what is my strategic allocation for this volatile stock, and what is my disciplined plan to build that position over time? Your plan is your power. It frees you from emotion and guesswork.